Hey guys, Freaky Finance here. 2 weeks ago we looked at Caleris. Last week I was at a wedding, so didn't do a video. But this week we're taking it into the energy sector with Vermilion Energy. If you guys have been paying attention, it's one that I own some call options in. We'll go through it today. So, full disclosure, there's my current position. And really, the idea with Vermilion is it's not a safe energy play, it's a leveraged energy play, but it's leveraged to the oil prices and European nat gas prices. And while they've hedged a part of it, they're still making quite a lot of free cash flow, and they're using that free cash flow to repair the balance sheet. And so basically it's a traditional deleveraging story, but the thing that's weird is that the oil price is already back to where they can start delevering, so it's no longer speculating on that. So maybe the market's trying to tell you that the current oil prices and nat gas prices are unsustainable, but even if they go down by a fair amount, they're still going to be able to crank out quite a bit of free cash flow. Ultimately, it's riskier than the Suncor video we did, just based on the balance sheet. But this company has a lot of torque to energy prices, and when you go through the numbers, you're going to see exactly what torque means, and just how much better the company is when oil prices are where they have been. So Vermilion has a lot of assets all over the world. It's one of the strengths of Vermilion is that they are fairly diversified. So they have North America production, and then they have European, and they have Australian, and different areas for different commodities. So in Australia, for example, they sell Brent, and in Europe they sell both oil in France, and then they have quite a bit of nat gas generated in Ireland, Germany, and we'll go through that real quick as well. I jumped through the numbers. Here's probably a good pie chart. Production split out, and you can see the kind of like the four commodities they offer. So obviously oil, but one's priced in WTI and one's priced in Brent. Brent generally yields better prices. Then you have European and nat gas. And you can see the FFO contribution estimate. It's fairly split, so about 36% gas and 54% oil. So you'll notice that European gas is only 17% of production, but it's giving 24% of FFO contribution. And one of the reasons why I'm doing the video today is because nat gas in Europe has been quite the squeeze going on over there. So anyway, that's why I'm doing the video today. So on their Europe assets, kind of talked about how France, they're pretty good at on the oil producing side there. But they do have quite a bit of natural gas production, Ireland, Netherlands, Germany. And they have these they have quite a bit of land actually in more eastern, southern Europe. But again, that's kind of more exploration. When you see exploration costs, it's probably going to be more linked to this area. And in North America, it does generate quite a lot of its cash flow from Canadian markets on the oil side. But really, you're owning Vermilion for torque and oil and gas prices. And so far, oil and gas prices have done quite well this year, which is kind of what we thought. I'm going to link a video that like a January 1st video I did for the beginning of this year, and it's kind of funny to go back and think what we got right, what we got wrong, right? So I'm going to put that at the end of the video just for some context, because there's some little energy blurb in there, but I go all over the map. Australia, so this is really good margins for their offshore here. I already told you that it's priced in Brent. For its production level, it actually yields quite a lot of free cash flow. One of the things when we jump to the numbers is just production, North America and international, and you can see North America has been ramping up in production over the last 3 years, quite heavily, right? But it's starting to fall back down again. So is international. One of the things that's been happening is a lot of oil companies, instead of, even though oil prices have come back up from the negative 2020 part of the year, they're hesitant to put money into capex. And I think that's one of the reasons why this oil price bullish market might last longer than people think. I mean, the upsides will be kind of limited by both the pandemic as well as OPEC, right? If oil gets too high, they'll just put more capacity online. But nevertheless, here, a lot of the companies, the producers, are not putting cash to work to increase production, at least not yet. AKA, they're not chasing the higher prices yet. That's what I'm trying to say. So when we jump to the numbers, it's kind of funny. So I remember doing a video on Suncor after Q2 2020, and it was just horrible, right? Because oil prices were in the toilet. I think they realized WTI of like 28 or something that quarter, which was crazy, right? And importantly for Q3, we know, well, today is September 18th, so we already have 10 of the 12 weeks that we know for the next quarter. That's going to be pretty good for WTI. It's actually going to come in ahead of this probably, unless there's a really sharp drop in the next 2 weeks. But likely Q3 will be very good as well for cash flow for both, for pretty much all oil producers. but specifically the ones that I own, Suncor and Vermilion. Anyway, so we're just going to go through the quarterly real quick because I want to kind of show just what torque really means. Ultimately, this year-over-year comparison is kind of skewed because prior year WTI they realized was only 27.85. So when your WTI realized price goes from 28 to 66, you're obviously going to make some money, right? And we'll go through that right now. I kind of break out their three main lines. So they have their normal oil crude. That's very heavy Canada focused and France heavy and Australia. Basically of this $275 million number for the quarter, 153 came from Canada, 68 from France, and 31 from Australia. So those are the biggest contributors. Kind of just maps out what's producing what in the context of the quarter, right? NGL is actually all from Canada, about 10% from the US, so and that shot up as well, about 158% year over year. NGL prices have been doing really well, and that's probably the best spot to be. I'm actually more heavy into nat gas than I am into oil, and I guess I should also show those as well, just so you have some context of what I'm currently in on the nat gas side. So these are 5 nat gas plays. So I'm still in Advantage, I'm still in Pay2, sold Birchcliff, I'm in Tourmaline, and I added ARC recently. We'll have to see what goes on, right? You might be like, well, you're adding a nat gas at these prices, and why haven't you sold yet, right? When nat gas is ripped from 4 to 5 and actually hit like 560 one day this week. Just at the share prices, well, they have gone up quite a lot. And a lot of people would, if they look at a chart, they'll just see that, right? But these companies' cash flow at these prices is just ridiculous. Like, I think ARC is like 2 times cash flow for 2024 or something like that at these prices, assuming they stick, right? Obviously, the market's trying to tell me that these prices won't stick. But anyway, I'm fairly bullish on nat gas. I'll be like, why do you own a services company? This is just a compressor company, this nat gas services group. This kind of tells me when the swing in production and fracking in the States comes online, because this is an American company. Nat gas services play, it's kind of more like, if this starts doing well, it tells me that America fracking is picking up, which should put pressure on the price over time. And it's my early warning signal. If this starts rallying, that I should start taking some profits in some of my energy exposure, or at least that's what I'm thinking out loud anyway, right? We'll have to see if that works or not. These are just my own thoughts. Anyway, back to Vermilion. Royalties did pick up quite a bit, so one of the energy, especially when it swings like that, it's very funny to see the delta year over year, right? So you can see revenue is just ridiculous because commodity prices have been ridiculous, the swing, right? But on the royalty side, it's also kind of funny. So royalties swung, main swings from Canada royalties. Canadian government makes quite a bit off these producers. Royalties paid went from 16 million to 41 million, so it also increased, say, 150% or something like that, which is in line with what the nat gas revenue increased by. Which is kind of what you expect. It is a natural offset, right? If the company's doing well, they're going to be paying more in royalties. Transportation, so this tells you the torque, these 2 lines right here. So even though revenue went from basically 200 million to 400 million, so it doubled basically. So we'll just say for the quarter, you can see that transportation expense only went up 5 million, and then operating expenses actually stayed flat. It's even more skewed than normal because production actually decreased year over year for this company. But it still suggests the scale, right? You can literally generate twice the amount of revenue, but not have to dramatically increase your cost base, really, right? That's what this shows. Though again, production to go down, so you would expect some decrease. It's not like they were growing last year. Everyone was pulling back in capex because prices were so bad, and so we're starting to see the effect on certain companies, some more than others on the production side. So usually when you pull capex, that means future production gets weaker, which means your future cash flows get weaker. Obviously it depends on the pricing environment, which is what this exercise should imply over time. One of the things the company did is they also cut D&A expenses. I'm not sure if it's permanent. It is small in the context of the overall company, but gone down about 50%. It's pretty interesting. I was digging a little bit to see what was going on there, and I'm thinking a part of it could just be finding some cost savings during the COVID last year. But I also think part of it is reducing pay to executives. I think there was a lot of pushback on this company last year because they weren't shareholders weren't happy with how this was being run. So I think there's quite a bit of cutbacks here on management salaries because this company was getting priced like it might be going bankrupt last year, which tells you the debt level. Right? And we'll get down to the balance sheet in a second. So anyway, GMD up about 200 million, which is about the swing in revenue. We're going to see depreciation up, huge swings in derivatives. So now they have a loss in derivatives because they hedged some of their production, and nat gas prices and oil prices have ripped over the last 9 months. So you can see that pretty swingy. They reversed an impairment. So last year they were having impairments, and this year they're reversing them. That's another noise factor for oil and gas companies. And one of the things that's interesting is that interest expense is still elevated, but it might start going down in the future, but we'll have to see, because debt balance has started to finally go down because the cash flow is starting to kick in. And then one of the things as well, when you start making money, you pay more taxes. So there's another $110 million swing in taxes, right? So there's a lot of noise on these year-over-year quarterly numbers for energy companies. It just tells you how much torque and how much natural offsets there are. So the bottom line for earnings, like, you really got to look at cash for oil and gas companies, because if you look at earnings, you're not going to get the right thinking, or the right numbers. It's just, you're like, oh yeah, the company's way better, right? And like, yeah, it is, but you really just got to look at the cash flow. So the FFO, and we'll go down that in a second. Share price obviously has improved from last year, and we'll go through the chart in a second, but the company's still down from where it was. It used to be over $20 a share back when WTI was 65, right? Even 60. And now we're at WTI 70, and the share price is still under 10, right? So something's not right there. It's either the market telling me these oil prices aren't going to last, or at least there's some type of impairment in the long run. And that's not just specific to this company. There's a lot of oil companies that are undervalued. No one's buying them. So maybe it's telling you that the future is going to be impaired for these companies. Anyway, you can see the equity market cap up about 600 million or 900 million. But it did do 800 million more in quarterly gross margin dollars, right here. So yeah, the company is 840 million more expensive in terms of equity value, but the company is now generating $800 million more in gross margin dollars if these prices hold. That's what I'm trying to say, is that yes, it's gone up, but it hasn't gone up enough as this performance would indicate at these prices. So anyway, total indebtedness has started to go back down. Actually paid off 155 million in the last quarter. And then again, that suggests the torque to commodity prices. So you can see total indebtedness start going back down. It's still fairly high. Like if you were to do a debt to equity, you would be over 1 still. You can see that right here, 1.7 billion in debt versus 1.6 billion in equity value. So the total EV, you just add the two up, and the total company is valued at 3.3 billion, right? But the company is torquing at like 400 million in free cash flow a year. So 8 times free cash flow. But technically, just operating cash flow per share, you're probably getting around $4. But again, that's because the debt level is so high. CapEx exploration has started to come back. It's still down from where it was. I think they're guiding to around 350 million in CapEx, between 300 million and 350, I think it was. Anyway, you can see the cash flow from operations, both free cash flow here, more than doubled, about 150%. And then you can see FFO more than double as well, maybe about 110%. Now the company's basically taking cash flow and paying down debt, because they know they got in trouble last year. They got spanked pretty hard by the market. Yeah, at the bottom here, you can just see what they're doing with the cash. They slashed the dividends last year. There was an emotional response to that, because this company was paying quite a lot in dividends before they slashed. I think a part of that was the company deciding to reward shareholders in dividends instead of actually managing the balance sheet. And now they're forced to manage the balance sheet, right? So anyway, that could happen. So what happens, they slash the dividends, and now they're paying down debt because the commodity prices have rebounded. And they're probably, the idea of owning this is basically they're just starting to deliver with the cash flow, and then they should re-rate higher, because currently they're priced pretty poorly based on their free cash flow. And I think that's because of the debt level, or at least that's my angle here. Total production is down quite a bit, more than 100 a day to 86 a day, and they're guiding to about 83 for the year. So it's not 83 to 85 anyway, so even worse in the back half. Again, CapEx only about 300 million, and if CapEx gets pulled, you see the production go down. That's what you see here. That makes sense to me. Obviously the company's much better, even though production's been down, because commodity prices have been good. So while these look like super scale, our production went down. So really, if commodity prices stayed the same, would these have also still crept up or not, right? Because technically this should go down if production went down. Anyway, something to keep in your back of your head, but obviously at these commodity prices, it doesn't really matter. But I always look at it because I'm trying to see what's management doing, right? Because management doesn't control the revenue side, control the cost and the production. Well, you could say production is part of revenue, but what I'm saying here is that the whole reason they did better is because of the revenue from the commodity prices. It's not because of production. But you can see all the metrics look good, and again, it's because percent of revenue, they all did really well because commodity prices doubled. Actually went up 137% year over year. So I like to look at the realized prices. I did this with Suncor video as well, just to see kind of the swing. Last year around this time, it was like the opposite, right? It was they're realizing 60 and then they realized 30. It was like minus 50%. So now we're getting these huge swings, and I've never seen swings like that. I don't know, since I started. So what's that? 14 years ago. You can just see the natural gas at the hub. So this is the benchmark up here, and this is what they realized down here. for their 3 commodity offerings. But you can see the nat gas, just these hubs in Europe. Like I thought our swings were pretty bad, right? 55% at Alberta, 46% Henry Hub. But NEB and TTF, man, 350%, 400% increases year over year. That's pretty crazy swings, right? But they have hedged some of that, so they didn't realize the full swing, right? So it's kind of like a balance between what Alberta went up versus what the European nat gas prices went up by for their year-over-year increases. And it's also hedged, so they didn't realize the full power of the increase in commodity prices. And we saw that when we went through the income statement on the losses for derivatives. Just for interest, the NBP, that's the UK hub. So on this one, when you see, that's UK, and then TTF is the Netherlands one. Anyway, you can see here the company's making a case that they're cheap based on free cash flow, and that does appear true. Though, again, it's trading cheap because it's over leveraged. That's what the market's telling them, right? There's basically the market saying pay down your leverage and you'll re-rate better, in line with the Suncors and Tourmaline and Birchcliff and Pay2, other ones that I own, right, that have better balance sheets. And you can see that here, like Baytex is also up there in free cash flow yield because it has a lot of debt. Basically, this market's just saying, hey, pay down your debt and you'll re-rate better. That's why I'm in it. So again, just a typical deleveraging story at higher commodity prices. And you can see that here play out in the debt reduction. So it's not just me saying it, they actually are doing it with the free cash flow. They're paying down the debt. And you can see that this is just the revolver, this dark blue line. So they do have $300 million US in senior unsecured notes, but they do have a revolver that's slowly getting paid down as the cash flow comes in, which should help interest expense. For the hedging, they have hedged quite a bit for the remainder of this year. Importantly, they're starting to pick up some higher floors and ceilings on the European nat gas side. You can see they've already hedged about 50% on the European nat gas for 2022. And that's important because the European forward curve for nat gas is actually pretty good. It's actually in contango, so it's like basically you can hedge out at a higher rate. So instead of, because our current WTI is still in backwardation, so you're like hedged at like a lower rate than what the spot is currently. So you kind of don't want to hedge, right? That's what it's telling you. But at the same time, at these prices, you look, when you're making hedges, you're basically just trying to de-risk what you're going to produce in the future, right? To try to secure some free cash flow and just reduce the volatility in your earnings. That's the idea. But anyway, you can see this company is starting to take advantage of this European nat gas that's happening. So this is actually exciting for me for this chart. Normally, I'm not a fan of hedges because I've been bullish for so long. But now that the price is actually up there, especially on this European nat gas, I'm glad they're starting to peg some of the higher cost, right? Like, oh yeah, we'll sell it to you at this price in a year out from now, even though the price is even higher than the skyrocketing prices right now. It's pretty good. So I'm looking at this. I'm gonna look at this the next quarter as well to see if it's going up or down. You can see net debt start creeping down. We already talked about that. And again, that's on the revolver. 150 million less over the last 6 months. On their Q2 letter to shareholders, so the most recent one, kind of suggested that they're probably going to put another 50 million in capex in the Q4, given where commodity prices are. So we're going to start seeing some capex creep to chase the higher commodity prices. That's going to be an industry-wide thing. But a lot of people have held off putting capex back into the model to date, which is supporting of the nat gas and the WTI prices. And you can see kind of what their target net debt is. So basically they're saying over the past year we already paid 330 million or 19% of our revolver back, which isn't small, right? You paid 20% of your revolver down in a year. Do that a few more years and you're laughing. But you can see that their leverage went from 3.4 from 4, and they're still targeting 1.5. So they got still a ways to go, but they're getting that debt to FFO down pretty good. So a part of that is also the FFO is improved because commodity prices are so high. So the trailing 12 months is going to keep ticking up, but assuming Q3 is good, which I think it will be, given where commodity prices have traded for this last 10 weeks. So anyway, the stock looks pretty interesting, right? So we just had a pretty good June quarter that we went through, and now we're probably going to see a pretty good July to September quarter once it finishes. Though the share price it's actually down from where it was, even though commodity prices are higher on the European nat gas side, higher on the North American nat gas side, and about maybe flat relative to here on WTI, even though it's still over 70. So anyway, what I'm trying to say is the company's still making a killing, but it's pulled back from where it used to be just 3 months ago. But then if you look over the year, like before COVID, you can see this was a over $15, $60 stock. It's on the Nasdaq. So this isn't the Canadian ticker, but the ticker's the same. It's VET. But you can see this company used to be over 20 US, and that's just 2 years ago. But the company is giving off cash flow that's in line, and the share price was up here in this area, right? So it's still 100% away from where it used to be, even though the underlying performance is actually back and actually better than what it used to be. Or at least that's my angle. That's why I like it, and that's why I'm doing the video. Is even though the catalyst has kind of played out, the commodity prices are back, the cash flow's there, the market's not believing it's either sustainable or they just don't believe in the company anymore. But you can see that's quite the gap, even though it's generating more than 100 million in free cash flow a quarter now. And it is starting to repair the balance sheet, so it's actually doing what it said it would do, which is delever. We'll have to see what happens, but right now it looks pretty attractive. Hence the video. Anyway, I'd like to know your thoughts. Rambled a little bit there on the oil and gas side, but yeah, I'll probably do a nat gas video in a bit. I own quite a few of them. Anyway, have a great rest of your week.